Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Hello and welcome to today's lesson, our first introductory lesson, Introduction to Accounting. We start off with what is accounting?
Hello mates, on today's video you'll get to know what is accounting. So let's check it out. Accounting is a language of business. It's how the business tells its stories to everyone else. Imagine a business that sells smartphones. It has sold one phone for $200, but originally it costed them $100 to be manufactured. This means they have made a profit of $100, which is the selling price minus the cost. You see, it's a very simple story. And if the business wanted to tell this story to others, it will tell it in numbers. It will tell it in accounting. And that's the language of business, of course. But it does depend on who are we telling the story to. We might like to tell the story to our internal managers. We can tell it to investors and banks. And we can tell it to the government as well. If we're telling it to the banks and investors, it's called financial accounting. And we would love to show off our profit and performance so that the bank would lend us more money and the investors would invest their money on our business. If we're telling it to the government, it's called tax accounting, and we would prefer to keep a low profile and show it as a poor performance, because the more profits we make, the higher taxes we'll be paying for the government. So what about when telling the story to our internal users and managers? It's called managerial accounting. But shall we show off our profits or shall we keep a low profile? Well, telling it to our managers should be just accurate, because it's this kind of information that helps the managers make the right decisions. So we'd better not hide it and we'd better not exaggerate it at the same time. We just tell the truth. In this video, we've covered the simple idea of accounting and the three types of it. If you've got any inquiries or questions, please leave me a comment and I'll be more than glad.
Our definition of accounting. Accounting is communicating financial information to users so that they can make decisions. So it's financial information for decision making. Now, uses of accounting information. There's quite a few people that use accounting information. We've got the management of a business, the owners of a business, banks that are supplying finance or banks that are about to supply finance, suppliers, customers and employees. Management and owners want to know how their business is doing. Is it profitable? How profitable is it? What are the major expenses faced by the business? What tax needs to be paid? How much tax needs to be paid? Which of the products that the business is producing are most profitable and which are the least? Can the business finance an expansion opportunity? Banks want to know, will a business be able to pay back the money it owes and whether they should lend more money to the business or any money to the business. Suppliers want to know whether they can extend credit terms to the business. So can they hold off for a while before receiving their cash? How much credit can they provide? Is the business a high credit risk to us or a low credit risk? Is the amount owed by this business going to be a bad debt? Is it now a bad debt? Will we get any money back if the business is wound up, put into liquidation? Customers, can we ask the business if we can receive better terms or a lower price? Will this business be able to supply us in the long term? Does the business have good enough cash flow to offer credit terms to us? Employees want to know whether their jobs are safe and secure. Will they be able to meet sales and revenue targets? Which departments are the most expensive to run? Which departments are the most profitable? Which products are the best sellers? Which products are on their way out and have falling sales? So lots of different groups of people associated with the business are interested in accounting information. Now, the users of accounting information and what they would be particularly interested in knowing. GST, goods and service tax, and income tax liabilities of the business. Obviously, the government would be very interested in accounting information associated with this. The potential for increases in pay or bonuses. What type of user would be interested in this? Employees. Possible return on investment. Investors. Profitability, the firm's ability to pay the debts and expenses it's incurring. Managers. Ability to provide a service or product or produce a product. Which user of accounting information would be interested in that? Customers. And the ability to pay for goods and services that had been provided to the firm. Suppliers would be interested users of accounting information there. Now we have internal users and external users, two separate groups with the use of accounting information. Two categories. Internal users. Internal users are those inside the business. External, those outside the business. Now, users of accounting information are not going to use just financial information. There'll be non-financial information they will need to consider when making decisions. So examples of financial information are the profit that the business has made or the amount of cash it has available to meet the expenses that it has incurred and its ability to pay debts. So a supplier wants to be paid, an employee would like to know they're going to be paid or whether the company can afford to give them a pay rise. Each user will use the financial information for different reasons. Non-financial information would be things like the firm's objectives, how it meets objectives, whether it's an ethical firm or not, and its commitment to the environment and the community. Now, you have a go here. Are these internal or external users? Get your pen and paper ready, please. Users of accounting information, the different groups we have here: suppliers, customers, bankers, competitors, managers, potential investors, trade unions, external auditors, public, government employees and owners. External auditors are those accountants that would be looking at the books, the financial information to make sure the business is legitimately reporting its facts and figures accurately. And perhaps the other one that we need to be aware of, trade unions. Trade unions are groups of employee groups which negotiate with management on behalf of the employees. So suppliers, they're outside the company, they must be external. Customers, obviously external. Bankers are not within the firm, they're external. Competitors, obviously external. Managers, they're within. Potential investors, external. Trade unions, external. Another internal one coming up, and the last one, owners, are of course internal as well to the company, to the firm, to the business. Different types of business ownership which we need to consider. When a business is started, the owners are going to decide which form of business ownership the business is going to take. The three most common forms of business ownership are sole proprietor, where the business has just one owner, a partnership, two or more co-owners, and we have companies subdivided into two groups. So we've got private limited liability company and a public limited liability company. Sole proprietor will be the focus for this course.
Getting the right legal structure for your business is essential, as this will affect how you do business in the future. We'll show you the common types of legal structure and find out which one may be right for your business. The legal structure you choose will affect the way you run your business and the tax you pay. This is because there are certain taxes that any business could pay, while there are other taxes that only certain types of business pay. So let's look at your options to make sure you choose the right one. There's the sole trader. It's easy to set up. You get to make all the business decisions, and you can keep all your profits. Record keeping and accounting are relatively straightforward, but you'll be responsible for any business debts. So what about a partnership? There are three types. There's a simple partnership, where the partners run the business and share profits equally. However, all partners are liable for any business debts. There are two other types of partnership, the limited partnership and the limited liability partnership. They are similar to simple partnerships, but limited partners are not liable for business debts. However, they have more complicated setup and reporting requirements. So you'll need to look into what these are and whether you can meet them. Whichever type you choose, one of the partners must submit an annual tax return for the partnership to HMRC. What about the private limited company? This is limited by shares or guarantee and exists in its own right. It can own property and is responsible for its own debts. But compared to sole traders or partnerships, a company has a wider range of reporting and tax requirements to meet. So make sure you research legal structures well so you can choose the right one for your business.
Exploring the forms of business ownership further. So when a business is started, the owners are going to decide what form that business will take. Sole proprietor, one owner who manages the business. Partnership, two or more owners. Company, one or more owners in New Zealand. So again, sole proprietors, that single sole trader, one owner who manages the business is going to be the focus here. The sole proprietor.
Being a sole trader or a partner in a business partnership are very popular ways of starting a business. This video will explain what it means to be a sole trader or partner. It will also explain what self-employment is. Once you've watched this video, you should be able to decide whether or not being a sole trader or in partnership is the better option for you. So, what is a sole trader? It is generally someone who runs their own business. Unlike other forms of business, a sole trader is entirely responsible for any debt the business may have. This means that your private possessions could be at risk if your business fails. This might seem like a scary thought, but don't let it put you off. There are many advantages to running your business as a sole trader.
Louise lives with her partner Patrick. They have a 3-year-old and another child in his second year at primary school. Patrick has a full-time job during the week. However, to supplement her family's income, Louise works 20 hours each week at a call centre for a credit card company, mainly weekday and Sunday evenings. When she has time, Louise makes her own jewellery, which she sells on her website. The credit card company pays Louise a monthly wage, which has had income tax and national insurance contributions deducted from it. This means that she's an employee of the credit card company. But Louise is also a sole trader. Why? Well, she's a sole trader because she's responsible for making all her own decisions for her jewellery making business. For example, she decides what materials to buy in order to make the style of jewellery she wants to make. She's also able to decide when to make the jewellery. Useful when she has so many other demands on her time. And what about actually selling the things that she makes? Again, it's up to her how she chooses to do that. We know she already has her own website. However, she's thinking of selling to customers in person. So she's contacted the local council to discuss getting a licence to have a stall at the weekend market in town. She's also spoken to an events promoter to find out how to get a stall at the major outdoor festivals and other open-air events next summer. What if her business starts expanding? She might need some help. Someone to run her website perhaps, or manage her paperwork while she's busy selling rings and necklaces at the festivals. If she starts employing someone, she becomes an employer. But it's important to remember that being an employer doesn't mean she stops being a sole trader. She can still be both. So, with or without an employee, Louise is definitely in charge of her business. This means she's self-employed and must therefore tell HMRC she started in business. She'll also, in due course, have to complete a tax return. You'll find out more about these tax issues later in this video.
So, a key point here, sole trader businesses, they are not a separate legal entity from the owner. The law sees the owner and the business as the same legal entity. And this means that sole traders have unlimited liability for the debts of the business. The owners are personally liable for the debts of the business. Their personal assets, their house, their car, their stocks, their shares, the money in the bank accounts, can all be used to pay for the debts of the business. And this is the main disadvantage of being a sole trader. There are advantages and disadvantages of being a sole trader. Advantages: the owner doesn't have to share the profit. The profit is all theirs. They can make the decisions themselves. They can choose to work the hours that they want. And the biggest advantage, that's why it's big here in bold, it's the easiest legal structure to set up and run with. Big and in bold, unlimited liability is the main disadvantage of being a sole trader. The sole trader, that person, their assets are on the line if the company incurs debts which cannot be paid back. The owner bears a loss alone. The owner is taking all the responsibility. It can be difficult to take time off if sick or time for a holiday. And the expansion is limited by the owner's personal resources or ability to borrow. Typically, a sole trader, banks are looking at the actual person's equity to be able to source the finance for the loan for the business.